Alrighty. So in today's video, I'm going to be sharing with you 6 steps that you can use to become profitable quickly when you're trading options from scratch. So if you're watching this video, I would assume that you're probably brand new to trading options, or maybe you have just started trading options for not too long, maybe under a year, and you want to know how to really grow your account steadily and consistently. So I'm going to be sharing with you these 6 steps, especially this is from my own experience, as well as helping numerous number of people to grow their account. All right, so step number 1 is to choose an options broker. So it's quite important to choose the right options broker because there are a number of brokers that actually allow you to trade options, but not many of them are actually designed to help you have a good experience when trading options, especially when it comes to constructing the strategy. So I'm just going to share with you a few of the brokers that basically would be good for trading options and also what to look out for. Now, if you are inside the US, then here are a few of the main choices. Basically, you have Robinhood, Fidelity, TradeStation, Interactive Brokers, Tasty Trade, and Charles Schwab, basically that have bought over TD Ameritrade and Thinkorswim. And then you have also Webull, right? So inside the US, you actually have quite a number of options to choose from. Now, if you're outside the US, then your choices are a little bit more limited, and also really depending on which part of the world you're in. So any of this broker would actually be pretty okay to trade options. Now, a few things to look out for when you're choosing an options broker. So these are the important details that you really want to do your due diligence in. And the first one is to actually find out from your broker, what happens to your funds and also your positions if it becomes insolvent, right? Let's say, for example, if the company goes bankrupt, what's going to happen, right? You want to make sure that there is some sort of maybe insurance, right? Is it insured by the FDIC? And what is it that they do in the event they go bankrupt? Are they going to return you your funds, or are you asked to transfer out your position? Or is this going to be like previously there was this brokerage called MF Global, where when it went bankrupt, I think a lot of people lost their funds along with it. So this is what you really need to be clear. So again, do your due diligence. The next thing is to look out for the commissions, right? So ideally, we want a maximum commission of $1 per trade. So maximum of around $2 per round turn. So as you can see down here, Tasty Trade, the first one, actually they have pretty decent commissions where it's just $1 per contract per leg, and they do not charge any closing commissions. So that means if you enter and exit, it'll be $1 round turn per contract, which is actually pretty good. So if you trade, the way that you trade is that you will get in and out of a trade without holding to expiration, then this will be pretty good for you. Now, if you're inside the US, then, Robinhood would be something that, many people like because there's no commission, right? Apparently, according to them, they said that the commission is free. So I know of some of my subscribers mentioned as well, it's free. Now, if you're outside the US, you won't be able to access this. So you might have to go for the other ones. Now, the other ones, this one is TD Ameritrade. So TD Ameritrade is also actually not bad. So I think now it's called Charles Schwab. So at least at this point, they're charging about 70 cents per contract. So it's pretty doable, right? It's still pretty acceptable. So round turn is about $1.40. Now, the next thing you also want to look at is exercise fees. Now, in this day and age, commissions should be getting very cheap. And also, most of the time, you should not be paying for, getting exercise, right? Exercise fees should be zero for the most part. For example, TD Ameritrade, or rather Charles Schwab, does not charge a fee when you exercise, but Tasty Trade actually charges a fee, right? So if you're the type that likes to hold to expiration, then you want to, select one of those that actually do not charge you for, exercising. Now, next, this is where you want to look out for to see, what sort of interest the broker actually pays you on your idle cash. So right now, at least as of this recording, the interest rate is actually pretty high. So you do actually want to make use of this because brokers are actually paying you, interest for any idle cash, right? So for example, this one is Fidelity. You can see that Fidelity is paying 4.97% on your uninvested cash deposit. So as you can see down here, they say that uninvested cash deposit in a Fidelity brokerage account is automatically put into a money market fund, now earning 4.97%. This one is Interactive Brokers at the bottom. Right, so Interactive Brokers says that you can earn 4.83% on your idle cash. But you must go and read the fine print as well, right? Because they said that only if your account size is above $100,000, then you are paid an interest. And the first $10,000 has no interest, right? Again, just going to find your options. There are many brokers that are going to pay you this interest, so you have to find out to see which one is good for you. So especially right now, where the interest rate is high, you do want to take advantage of this. But however, this is mainly inside the US, right? So if you're outside of the US, what you'll find is that the brokers actually do not give you this interest on your idle cash. Interactive brokers, I think they do, but you need a large account. But then, what if you have a smaller account? What can you do? So if you're outside of the US, then what you can look out for from the broker is maybe they have the ability to purchase T-bills and have a percentage of that released as option buying power. And basically the one that I found is Tasty Trade, right? So as you can see, this is Tasty Trade. So you can see that for Tasty Trade, they say we margin the T-bills at 94% in margin account. So remember, you have to open a margin account. So what happens is that if you were to buy $100,000 and put it into T-bills, you would still have $94,000 in buying power. So what it means is that this 100,000 is actually earning the return, the interest from the T-bill, right? Whatever percentage it is, right? I think around right now is about 3 to 4%. So you'll be earning on that full $100,000. Now, from that $100,000, you can actually use 94% of it and then use it to trade options. So in this case, you actually have a return on a return. So if your options is profitable as well, then you're going to have an added return. Now, if let's say, for example, you're experiencing a drawdown, then hey, at least the interest from the T-bill can help you, cushion some of the losses. So this is what I've actually done. So as you can see down here, I've bought like 210 T-bills. So how T-bills basically work, just a very quick run through, is that you actually buy them at a discount, right? So the full face value for this on Tasty Trade is $1,000, for each of these T-bills. So for this one, you can see I bought each one for an average price of $960.30. So this is where it will start off with. And over time, this price will start to go all the way up until it's the full price at maturity, right? At maturity, it'll be $1,000. That's the face value of this T-bill. So this is how the T-bills work. Now, next is the ability to see existing positions on the option chain. So for me, this is actually pretty important because I do trade, multiple positions on, the underlyings that I trade. So that means on each of the underlying that I can have 2, 3, 4, 5 positions going on. And that's why it's important for me to see these existing positions, because if you do not realize you have an existing position on the strike price, you could actually cancel out that trade, right? So let's say, for example, you can see down here, any red marking tells me that I have any, short position on that strike. So you can see down here, 185, I have a short strike. 189, I have the short option as well. And for 187, if you see green, it means that I have a long strike. So as you can see, long strike as well. So this is where it's very important, because if your broker does not show your existing position on the option chain, now if you have a new trade you want to place, and let's say, for example, it's the same DTE you want to put on, you do not know where's your existing strike. So let's say, for example, you have no idea. What you're going to do is you go and place a short strike at 187. And then you put a long strike at 185. If you do that, what's going to happen is that you're going to cancel any existing position you have on that strike, because you cannot have two opposing trades on the same strike, right? So one short, one long will naturally cancel that out. And if this is part of another strategy, so let's say, for example, you put on the Iron Condor. This is like, for example, the put side, the put leg of the Iron Condor. If you're going to put another trade on that cancels out these two trades, you're going to find that your Iron Condor suddenly has no leg on the put side, right? You only have the call side, and it kind of destroys everything. So for me, this is important. So for you, if you want to avoid this problem in the future, if you plan to have, more than, one position on the same underlying, then you definitely want to look out for the broker that shows this position. Next, step number 2, and that is to plan out your risk management. To me, this is very, very important, because you should not get into any trade unless you have already figured out your risk management, right? So what does risk management entail, right? Basically, it's what is the max risk on each trade that you want, right? One of them is you need to know upfront how much you're planning to risk on each trade. So usually this is a percentage. Some people like to use dollar amounts, right? But if you want to keep things consistent, you want to go something for a percentage of your account. So this can be anywhere from 1% to 10%. And again, it really depends on, how big your account account size is and how many underlying or strategies that you're actually trading. So a general rule of thumb is that if you have a smaller account, then you want to go, towards a higher percentage. And if you have a much larger account, then you want to go for a lower percentage. And next is also you need to figure out what's the position sizing on each trade, right? So this depends also on what is your risk per trade. And from there, you can decide, how wide of a width you want for the trade. Let's say, for example, if you're trading spreads, and then from there, how many contracts. All this you need to plan in advance. And also, what is the total max allocation of your capital you will use at one time. So over here is a table, and this table is created by the Tasty Trade team. So they just gave a very general guideline as to how you're going to allocate your buying power depending on the VIX level, right? So as you can see down here, if the VIX is very low, generally you want to allocate around 25% maximum of your buying power. So let's say, for example, if you have $10,000, then you just want to risk 25% maximum around, the 10 to 15 VIX level. So let's say, for example, if each trade takes 5%, what that just means is that you want to have a maximum of 5 trades, right? So 5 trades of 5% each, that is 25%. Now, if the VIX is much higher, let's say it's around 40 plus, then you can allocate up to 50% of your total buying power, right? 50% of your capital. So if you have $10,000, then the max you will use up at any one time will be up to $5,000, right? So if you have a risk of, let's say, 5%, that will mean 10 trades. If you have a risk of maybe 1%, then that could be 50 trades, right? So for me, I just adhere to a maximum of around 50%. Sometimes I may push a little bit more. Most of the time, I will be around 50%, right? So as long as you do not exceed this 50%, you can put on as many trades as you want, all right? So this is on risk management. Next, step number 3, you want to just choose one option strategy to focus on. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Right? Especially if you're starting out, you do not want to overwhelm yourself, confuse yourself with so many different option strategy. Just focus on one option strategy at the start, master that, and then after that, you can start to, add more strategies to your arsenal. So the question you have to ask yourself, what is this one option strategy to focus on? Should it be defined risk or undefined risk? Now, this really depends on your account size and also, where you are in terms of experience in options. So generally, if you have a small account, then you pretty much have no choice to go only with the defined risk strategies. Now, if there are some underlyings that is very cheap, let's say, for example, $10 or under, then those cases will be an exception because you may have no choice but to go with the undefined, because going with defined just does not make sense, right? So in those cases, you probably can go for the undefined ones. But for the most part, go for the defined risk, because this way you already have your max loss cap at the start. You don't have to worry about, one loss that will wipe out your account. Now, if you have a large account, go with undefined risk strategies. But generally, as I mentioned, if you're just starting out trading options, just start off with defined risk strategy because the max loss is capped. So now that we have already decided that we should focus on the defined risk strategies, exactly which strategy should you focus on, right? Because there are many different strategies in the option world and one could get easily lost. So I'm just going to give you a few, and I'm just going to give you my suggestion on which one you can begin with first. So the very first one is, the very popular credit spreads, right? So credit spreads come in 2 types, right? The very first is the bull put spread, or basically what's called the put credit spread. And then you also have the bear call spread, or what's called the call credit spread. So credit spreads are very popular, but they are more directional in a sense whereby you do want to get right on the direction. Otherwise, this trade can tend to lose. The next one is iron condor. So if you're not that good at picking direction, or you just do not want to pick direction, you just want to play, what's called the expected move, right, and have an edge in the long term, then you can trade the iron condor, right? Because iron condor, you do not really have to pick any direction. You just have to put it on and just see, over time, does it actually give you an overall net profit? right? So there are certain mechanics that you have to follow in order for you to have that edge. And on my channel, I've already created numerous number of videos on this, so I won't go into details of choosing the strike price and the DTE here, because you can just go to my channel. I'm just going to give you an overall big picture, and then after that you can further do the research and study into the individual strategy that you've chosen in my channel. So basically, this is the Iron Condor. Good for you if you do not like to pick directions. Now next is what is called omnidirectional strategies, and omnidirectional strategies have the highest win rate of all the strategies that I shared here. So omnidirectional strategies basically are strategies whereby if the market goes up, you can make some profit, market stays in the middle, you can be profit, market comes down, you can actually make even more profit as long as it does not go way too down. So omnidirectional strategies are pretty good, especially if you're starting out, because you have many different profit zones. And in a way, it's pretty defensive because you have the way to construct it whereby if the market comes down, you can actually make quite a bit more. And as you know, most of us are afraid that the market actually goes down, right? We are afraid of a market crashes, and people will always talk about what about those black swan events, so on and so forth. So when you trade omnidirectional strategies, at least if the market goes down, right, you still have an opportunity to make even more than if the market goes up. But if the market goes up, hey, at least you still make something. So the very first one is what's called the Jade Iron Condor. So as you can see down here, it's very similar to the Iron Condor, the previous one. As you can see, there are both the put spread and the call spread, but the difference is that the call spread, you'll notice, is much smaller, right? It's much smaller mainly because we do not want any risk to the upside. So we will craft it in a way whereby even though if the market goes up, you still can profit, but this is where we are going to make the most profit, is where it's inside the max profit zone. Now the next omnidirectional strategy is what's called the put broken wing butterfly. So the put broken wing butterfly is even more defensive than the Jade Iron Condor because the max profit zone is really somewhere around here, right down here. So this strategy tends to make the most if the market actually comes down into the profit zone down here. So when you're trading this strategy, you actually do want the market to come down. But if the market goes up, you do not worry as well because there is no loss on the upside. So similar to the Jade Iron Condor, no loss on the upside. If it goes up, you still get some profit. And one good thing is that it actually benefits your psychology because a lot of people, like I mentioned, afraid that the market comes down. But when you put on the put broken wing butterfly strategies, what you'll find out is that you're actually looking forward to the market going down because that's where your max profit zone is, unlike the Iron Condor and the bull put spread. Now, the last omnidirectional strategy is what's called the put condor. So the put condor, again, very similar to the put broken wing butterfly, but this time we have a much bigger profit zone, right? A much wider profit zone, and we're only using puts for this, right? So the whole idea of this strategy is to have a very defensive structure whereby number one, you have your put credit spread. So you want it to be slightly bullish, but you're afraid the market comes down, right? So if you're afraid that the market comes down, what you do is you take some of the credit you receive from the put credit spread, purchase this put debit spread. So if the market comes down, you can profit on this put debit spread. And again, I've already created a video specifically on this strategy. If you're interested, just go ahead to my channel and then just look for that. Now, any of these strategies down here, I would say is pretty suitable for you if you're starting out. But if you want to become profitable quickly, that means you want to have, more wins than losses. You want to see your account, start to grow pretty consistently. Then what I would suggest is to go more for these omnidirectional strategies. So these omnidirectional strategies have the most consistent results. And this is something that I also encourage, many people to start off with if they are brand new. Now, next, step number 4 is to decide the underlying that you want to trade. So now we have already chosen the broker, we've already gotten our risk management, and we've already decided which strategy we want. Now, the next thing is to choose the underlying. So how do you choose the underlying? So generally for this case, what I like to do is to use this strategy that I've already chosen and then find the right underlying that suits our strategy, right? So this is how I do it. So if I know the strategy that I chose has a certain characteristic, I want to find the underlying that will kind of benefit the most from it, right? So for example, if I choose the put broken wing butterfly, What it means is that I want an underlying that actually has positive drift. Basically, positive drift is whereby the market just wants to keep going up over time. So what kind of underlying have these characteristics? Basically, is the index ETFs. So basically, there are two types of underlying that you can choose from, right? You have individual stocks and you have index ETFs. But my suggestion for you, especially if you're starting from scratch, you're new to trading options, I would suggest index ETFs. Right? So if you're just starting out, go with index ETFs. Well, one of the main reasons is because index ETFs actually don't move as much, right? So you can see over here, this is a study done by the Tasty Trade research team where they went to compare the movements between ETFs and stocks. And what you will see down here is that for ETFs, they tend to stay in a much more narrower range compared to stocks. Stocks is much wider. So when we are trading premium selling option strategies, right, especially, some of the strategies I just shared with you, we do not want the underlying to move so much to test our short strike. Also, with index ETFs, there are no earnings, so you can continuously put on trades. Next, why we also want to choose index ETFs, because bad news on a specific stock doesn't move the index ETF as much. So as you can see, bad news really affect the individual stocks a lot, right? So this is Disney. You can see that Disney stock basically got affected whenever such news comes up. Like for example, there's a bad launch, this Avatar sequel fails, and the stock price is down 45%, right? That is a very big move. So, if you put on, some of the strategies I shared with you, although those strategies win most of the time, one of these big moves can really wipe out a big part of your winnings. And finally, there are already lots of studies and research done on index ETFs to show that you can actually have an edge in the long term. So as you can see, this is the studies done by the Tasty Trade research team. Again, when we're trading any strategy, we want to lean on research, right? We want to lean on study, because how else will you know that there's going to be, profitability in the long term? So you want to lean on all these studies as much as possible, compared to if you do not have any studies to lean on and you're just leaning on your own understanding, which is not enough, right? Every time when we come to trading any of the strategies, we want to be objective rather than subjective. So as you can see down here, these studies are usually all done on the index ETFs like SPY, RWM, so on and so forth. So next, step number 5, and this is a very, very important one, and one that I really stress on that everybody actually does, is to plan out all your trade scenarios, right? So how many times, maybe you've experienced it, is that when you put on the trade and then all of a sudden the market crashes, or the market goes all the way up, or it tests any of your strikes, and you're not sure what to do. You'll be surprised. I get so many emails from, my subscribers. They send me an email saying that, hey, Davis, my position, so-and-so has been caught and now I'm losing a lot of money. What should I do? Right? My take is that if you can reach out to me or anyone to ask for help on what to do, you shouldn't be in that position in the first place, because you should have already planned out all trade scenarios, including your worst scenario, and already know what to do beforehand. So all you got to do is follow your plan, right? If the market crashes, the market goes up, test your strikes, whatever the market does, you already have, all your scenarios laid out, a plan that is right in front of you. Just go to that part where it says, oh, if the market comes to, all the way down, I already have a plan. I'm going to just execute it, right? So this is very important. So what this step basically just means is to plan out every possible scenario that can happen after you enter into a trade. So what this does is also, it helps you, face the reality of trading, face the worst thing that can happen, because you'll be surprised, right? A lot of people do not like to face what's the worst scenario that can happen, because I did ask many people as well, hey, what if the market crashes and your position is tested? What do? Well, a lot of times the answer will be, I don't know yet, right? Let me just get to that point and then I'll decide later. Well, if that point actually comes and you don't know what to do, then you're in for a very painful ride. So again, you must plan it out. So how do you plan it out? So these are some of the questions you need to ask yourself, right? Like for example, what will you do if the market goes up? What will you do if the market goes down? What will you do if the market goes sideways? What will you do if your strikes get tested? Where will you take profit? Where will you cut loss? Where will you roll? And if you do roll, when and how will you roll? And when will you exit, right? All these are questions you must have answers to. So what I'm going to do right now is just give you, a trade example and just show you how you can map out all the different scenarios and then have a plan for it, right? So there are actually many different scenarios for each trade. So I'm just going to give you a few. Let's say, for example, you have a trade. So this is the trade, let's say you plan to put it on, is to sell this $5 wide bull put spread, all right, 175, 170 with the 50 DTE for $1.30. So again, you want to be as specific as possible. And then you want to map out the scenarios now. So scenario number one, let's say the market goes up, right, to 185, or it goes up in general, and your bull put spread is now 60% in the profit, and there's 30 DTEs left. What do you do, right? You need to have an answer for this. So I'm just going to give you a guideline, is that generally there are just three decisions, right? Just three decisions that you have to face. And that is, do you hold, right? Or basically just means you do nothing, or should you roll it, or should you close it, right? Basically, just these three things. Then you have to decide for yourself. So this is scenario one. Then maybe the next scenario you want to plan is, if the market goes up and your bull put spread is in 40% profit and there's 21 DTE, what do you do? Again, do you hold, roll, or close? You need to have an answer. Scenario number three, market stayed flat, right, around $180. Your bull put spread is in 20% profit and there's 30 DTE left. Do you hold? Do you roll? Do you close? You want to find an answer that is suitable for yourself. Scenario four. Now, this is where things get a little bit tough, right? Scenario 1, 2, 3 is basically when you are in a profit, right? But now this is where you could start to see a loss. And this is where you really, really need to have a very clear plan on what to do. So scenario 4, one thing that can definitely happen. So let's say, for example, you have a bull put spread, market comes down, test your short strike. What do you do, right? Do you hold? Do you roll? Do you close? Now, scenario number 5, what if the market just simply blows through your strikes, right? It goes even below your long strike. Now it's almost at max loss with 21 DTE left. What do you do? Hold, roll, or close? You need to find a plan that suits you. So for some people, it might be just to hold because there's not much left to lose. For some people, it's to just exit it very mechanically because it's 21 DTE. For some people, it's to prolong the trade, it's to roll. Again, find one plan, suits you, stick with that. And finally, step number 6, once you plan out everything, especially for step number 5, time to place your trade and execute your plan. So a few things to look out for. So first of all, just as you start to construct your trade, make sure that you see a net credit. So some people have actually made this mistake before. Some people have reached out to me. They said that they actually thought it was a credit, but it turns out to be a debit. And now the trade is not as good as what they thought it should be. So always ensure you see a credit. Okay. Now next, when you already decided on the credit that you want, this is where you want to adjust the price a little. So what I like to do is to always start off with the mid price. So when you place the trade, what you notice is that there'll be this slider, right? At least for most brokers, they should have that. So what they will show should be the mid price and the natural price. So natural price is NAT for short. Basically, this is where you are pretty much guaranteed to get filled, right? So when we are doing this trades, basically we are trading this premium selling options. We want to get as high of a credit as possible. So I'll start off with somewhere around mid, and then I will gradually just shift it lower and lower until I finally get filled, which is near the natural price. So let's say, for example, I may start off with 1.99. If I put the trade in, I do not see that I get filled. I'm just going to adjust it, right? This can be, a few seconds, maybe up to a minute or something like that, especially if I want to get filled. Now, if you do not mind waiting, and this is the price that you actually want to get filled, then you can just put it in the market, right? There's no need for you to adjust if you do not want to get filled immediately. But if you want to get filled immediately, then you just have to keep adjusting. As you can see, adjust it bit by bit until finally you get filled. Now, once you're filled, you can set your take profit. Now, this is optional, right? Because some people like to just exit the trade at 21 DTE, especially, those who follow those tasty trade mechanics. If you want to get out 21 DTE, then no need for you to place take profit. But if you want to adhere to some take profit, maybe 50%, 40%, 90%, whatever it is, just put the trade in, right? Rather put in the order to just simply do the take profit. This way, you don't have to always monitor the market. Finally, the last one, now that you have gotten everything in, it's time to execute the plan that you've set out in step 5. So again, very important. If you already have this plan out in step 5, you need to stick with it. Because many times you'll find that some people have the plan, and then when the losses actually hit, the worst scenario actually hit, suddenly people just don't want to stick with the plan, right? Because they are thinking that they have this hope. What if the market reverses, and if I take a loss now, I will regret it, because if the market goes up, I could be in a profit. But on the other hand, it could work the other way as well, because what if the market continues to go against your position, and then you suffer a bigger loss than you should? So again, once you got a plan out, just stick to it. All right, so these are the 6 steps. If you're brand new to trading options, definitely use it. And if you get good results, do let me know. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.